Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris Haddon here with the Private Lenders Podcast. Thank you for checking out the show. A special episode with a special guest. We have Eddie Wilson, the founder of the AAPL, American Association of Private Lenders, and several other companies. We're going to dive into all that here today. Eddie, thanks for being with us. Thanks for taking the time.
Thanks for having me on. Looking forward to it.
No, absolutely. I know we've had a few back and forth on scheduling and stuff, so I'm glad that we were both able to make it work out today. If you wouldn't mind, could you take a couple minutes and tell the audience a little bit about yourself, your background?
Sure. Yeah. Serial entrepreneur. Grew up in a home of two entrepreneurs. Mom's a business owner, dad's a business owner, and started in corporate. And then, didn't make it too long. I always felt like I was going to try to improve everything around me, and ended up starting my own businesses. And so it's just been kind of an interesting journey. I've bought and sold close to 100 companies, and spent a lot of time in the private lending space and a lot of time in real estate. So today I have a private equity firm out of Florida. And a part of those holdings are the American Association of Private Lenders and various other companies. And so I kind of spend a lot of time in the lending space, mortgage space, insurance, events, so on and so forth.
You've been in several industries in a relatively short amount of time, it sounds like.
A lot. Yes, sir.
No, it's awesome. Okay. So I was doing some homework. I did my research.
Okay.
And I came across an article that you wrote a little while back, and you were talking about when AAPL got started. And that was not too long after we started Hard Money Bankers, our lending company.
Sure.
So we closed our first loan in December of 2007. My business partner and I had just come from the banking world. We're transitioning into private lending when everything was at the bottom. Everything had just crashed. And I noticed in this article that you said around the time you were starting AAPL that you thought that private lending would play an important role in helping the real estate market climb out of that hole.
Sure.
Could you expand on that a little bit? Because that caught my attention.
Yeah, for sure. 2008, we have the market crash. And, I spent a lot of time. I actually sat on a subcommittee for finance, and spent a lot of time in this space. And what was happening is, you've got the Wall Street Reform Act that happens in 2008, 2009. Banks are being given billions of dollars in bailout money, but also simultaneously the Dodd-Frank, rules and regulations come out, and 70% of all loan requests that were going to banks essentially couldn't be fulfilled because they didn't meet the criteria that Dodd-Frank, essentially set out for what a bank could take on as liability. So they have this huge vacuum in the marketplace. And, and it's what was happening the vacuum was hitting all the fringe real estate. And it was also hitting those that use real estate as a vehicle for investment. So there's a lot of, things that are going on. Well, all of a sudden you have this massive real estate crash. You have a lot of houses that now come back on the market because of they're distressed and their owners and all that type of stuff. But banks can't solve the problem. They're given billions of dollars and then they're told you can't actually lend on it. And so what did banks actually did what they could do to try to create revenue, which was buy more banks. They're essentially buying deposits by going to your local bank and buying that bank. Well, there's a huge vacuum. And so private lending, which, back then was just traditional hard money lending. It was, mom and pops that had some discretionary capital that they could deploy it in the marketplace, get a good return. They are now in the highest demand. And you go all the way back to 2009, 2010, all of a sudden Wall Street takes notice, and Wall Street looks at it and goes, wait a minute, these guys are making more yield than the market, than anything else we're doing. And you start to see institutional dollars start to go towards that hard money space, which really is the evolution of what we are in today. I mean, so much money that are originated by lenders in the private money space today, it's not their own discretionary dollars. It's coming from an institution. It's coming from a different source. And so I felt like it wasn't the dollars that the hard money lenders possessed. It was the vehicle by which they were underwriting and looking at these deals, saying like, hey, let's look at the value of the asset, not necessarily the borrower. If we had to take back this asset, how would we value it? And all of a sudden it became the vehicle by which, big institutional Wall Street money began to flow into this space, which really did create, if you look at the housing market, 2010, 2011, it rebounds a whole lot faster than the stock market does. And the reason it did was because capital started flowing into these opportunities, and it really did create what we have now, which is a massive, massive industry. Right now, I think NASDAQ said a article on NASDAQ about a month ago said that there's about 430 billion in liquidity earmarked for private lending right now. And I've talked to so many capital brokers in New York, and it's like, if that 430 billion got deployed today through real estate investors and real estate opportunities, there's another 430 billion that would come in behind it because it's still finding great yield.
I mean, the amount of volume that is being done, also the reporting's better now than it used to be, but still, either way, since institutional money came into the scene and, whenever that was, 2012, 13, 14, around there, the amount of volume that we see these lenders reporting that's being pulled from, data providers that are pulling from public record and everything else is just staggering. It's crazy. Right. And our niche in my company, and also like in the mastermind and everything else, we're all private capital. And so we sort of compete against institutional, but kind of not. It's not always the same bar. It's not always the same deal type, definitely terms. But an interesting part about that is related to our background in banking before the crash. And in conventional mortgage, one of the annoying things, with not so fun parts about the business model, is one, lack of control, and two, slim margins. And so when we moved over to private lending, where we controlled the capital, we made the decisions. We approved the wires. I'm like, wow. And then the margins, and granted, their pricing was even higher back then. I mean, it was 15 and 5 in 2008. It's not that anymore, and that's fine. The margins are still good. And so one of the things I noticed when the Wall Street guys showed up here in our office early on, because back then we were considered to be a big volume lender, not anymore, but back then we were. So they were here pitching capital. And I was like, man, it kind of sounds like we're going to lose that control. It kind of sounds like compressed margins. Are they taking this and turning into the conventional mortgage business? And I'm like, man, and then just play the volume game. You don't play the margin game anymore, play the volume game. So it's interesting how everything's evolved. Like what we hear, there isn't all that much content in this private lending space. I mean, obviously there's AAPL, Private Lender Magazine, which I was looking at before, Kevin Kim, and us. Pretty much. That's it. And you get different opinions and different viewpoints based on who's reporting it. And that's something that Kevin Kim and I discussed on the podcast. Is like modernization of the industry is a common term. But does that always mean making it better? Sometimes yes, sometimes no. And so these are the things we kind of debate and look at and everything else. And the kind of things we discussed like in the mastermind meeting like last week. Just some thoughts on the industry and, bouncing off what you mentioned before. But back it up again, let me ask you why. I mean, obviously, if you fast forward some time, we know that you're heavy into the event space in different niches. But back then, why start an association? Why start the conferences and that?
Yeah. My business partner, Anthony Gerasi, was the one who really pushed kind of the association. I'm a third generation real estate investor. And so why it made sense for me to be involved early on was I liked the concept of the aggregation of this capital, because oftentimes it was very desperate, right? Like, I mean, you had kind of your hard money guy that was wherever you were locally, but there wasn't a way to find these people, it's like, and so for me, I was a real estate investor. So I was always looking for capital, and, everybody, it's because it was all very much small niche type investors. They were doing private money. They kind of had their thing, and they were like, well, we only do fix and flip, or we only do whatever it was. And so I would find, random deals, and, they may want it, may not want it. So I got involved mainly because of the aggregation. I thought, well, wow, if we could, there is capital here, and they would like access to deals, and I would just like access to the capital. So I'll play along. And so it was more of that back in the day, And I came in a little bit later. Anthony was really the founder. And then the guy that I essentially bought the shares from was a guy named Mike Wren, who was an insurance guy. And he was just trying to figure out how to insure all these investment properties. And I think it was just a way to kind of put all these people together. It grew very quickly from 2010 on, though, when all of a sudden you needed representation. Like from 2013 on, I spent a lot of time in DC because the government and legislators don't understand that this world even exists. It's still today, right? I mean, like it's wild the amount of time I've spent in DC, and I'll start talking about private lending, and they'll say, well, and I'll say simple things like, do you think a private lender, a business purpose lender, needs a license? And I mean, 10 out of 12 people at HUD will say, well, I think so. I'm like, okay, well, what license do they go get? And what governing board is going to actually oversee that license? Well, HMDA or CFPB. It's like the C stands for consumer, right?
Consumer,
Like
all
so,
consumer, not commercial.
and so like I remember we actually Neiman Dogban, at Jurasi, we actually were in DC one time. This is 2014, 2015. We put a loan application in front of the Banking and Finance Committee. We said, this is the loan application that we are supposed to, by compliance, fill out. What gender is a LLC? What race is an LLC? Right? Like it was just like it was like their minds were blown. But the problem is like it really hasn't gotten much better. They don't know where to group business purpose lending, and it's just a lot of gray. So it really has morphed over the years. In the beginning, it was just more about networking and trying to put the capital and deals together. Then it became more representation. Like, wow, there's a lot of capital over here. There's a lot of money that really could solve a lot of issues. And now it needs representation. So that's where it morphed to.
No, that makes sense. And that, since you mentioned that, I remember that at one point AAPL's office address was DC, wasn't it?
No, we never carried a DC address.
Okay.
I was there a lot, and we did do a bunch of work there. I never believed that we were large enough to ever truly have a lobbying presence. And by the way, the AAPL is actually a for-profit association, which you don't hear very often. But the reason we built as a for-profit association was because we believed that this industry was going to be so small that we really didn't need a nonprofit to go out and raise money for or get grants for. It was like, we're going to have to be able to provide something of value that people will pay for because it's a small industry. And, still today, there's, probably 1,900 lenders that really make sense for an association like this. It's like, it's still very, very small. So we really have never taken a lobbyist approach. We've always taken an advocacy approach. It's always been me behind the scenes, meeting with legislators, educating them, talking to them. It's Nima or Kevin or whoever going with me, at the state house, representing, standing in front of Congress, testifying. It's been all of that type of activity that's really given us the success that we've enjoyed over the last few years.
Got it. Switching gears for a moment. So with all the conference and live event stuff going on, and we'll get to more of that soon. Have you always stayed a real estate investor?
I have. Oh yeah. I'm third generation. I can't help it. And real estate to me is the most predictable asset class. It has the high. For instance, it's like we're seeing what the stock market's doing right now, and all my buddies
Right.
in the private equity space are touting how great the stock market is at the moment. And it's like, yeah, but 2 weeks ago you guys were, a mess. And for me, it's just I know my consistent pathway, and so for legacy, for tax purposes, all of that is why I really stay primarily a real estate investor.
What are some of your favorite asset classes in real estate?
I
Asset
believe
types.
that in real estate, you play the games based on the board that's given, and I believe the board that you're playing on is the economy. And so I changed the asset type based on the economy. So like, for instance, I got, everybody was, talking about how distressed multifamily was over the last 2 years, right? Like you had REITs going belly up. You had private money lenders that had $300 million worth of bad debt on their balance sheet because of multifamily deals. That's when I started going, oh, this is when I need to play. And so I'm buying an apartment complex almost every single month right now, mainly because I feel like in real estate, you're always just a step ahead of where lending is, and then lending kind of catches up. And so I love, but there was a period of time where I flipped 9 hotels. There was a period of time where I did a couple hundred houses in a year. But right now, my holdings, I have about 4,000 real estate doors, but primarily it's multifamily. I probably have less than 150 single family doors. So I'm super heavy into multifamily. Right now, I'm really bullish on Class A. There's a lot of, in the period of refinance right now, it's like there's a lot of room, and the new liquidity standards and all the things that you need with Freddie. I'm picking up deals for 80 cents on the dollar in really good markets with Class A real estate.
So you think multifamily peaked a few years ago and now it's back to buy time?
Yes, I think it peaked, then it moved into a period of, and I think it was artificial as well. I think so many real estate programs out there taught people how to syndicate, but they didn't teach them how to operate. And so it's like they taught them how to raise the money, but not how to actually make the deal perform. And so you had a lot of money that just went into this space, and a lot of bridge debt that was extended by private lenders that all of a sudden the asset wasn't performing, the occupancy wasn't where it was, and they couldn't go get their long-term debt. And that's kind of the space I'm playing in now. I'm finding all of the sins, of people that didn't know how to operate it coming to fruition. And so now it's back to a buyer's market.
That's interesting. We've been taking a bit of a wait and see approach to acquisitions. Whether or not that's a mistake, time will tell. Because we operate the lending company full time. That's our thing. So years ago, we sold off our rental portfolio that we managed ourselves and have just been investing with a few operators, mainly in commercial stuff, self storage, multifamily, a little bit of office. And our buy time most recently was like 2020 to 23, 22, 23. And since then, we've kind of been like, all right, let's stabilize, see how we're doing, maybe look to sell some stuff. Like that's a big debate that goes on all the time is that, everyone wants to hold for tax reasons, for legacy reasons. And I like that idea sometimes. But
Yeah.
oftentimes, and you'll probably agree that you get in a situation with a piece of real estate where the equity that you're looking at is a lot more impressive than the cash flow.
Right.
How long is it going to is it going to take to make in cash flow the amount of equity that we're looking at? So, all right, maybe it's not always hold.
Yeah.
Right. And so we've been having those discussions recently.
I I
Good
see
problem to have.
my CFO has an equation where we look at the repayment like we look at what would it take to actually, from a cash flow standpoint, we have a year essentially to actually pull the equity out. Like if it paid for its equity, right? And there were so many single family assets that it was based on the cash flow I had, it was going to take 50 years worth of cash flow to actually give me my equity that was currently sitting in there.
Yep.
And you can't, and I can't go refinance because the cash flow is too thin that it wouldn't even cover its debt service. So it's like your only option in those situations is to sell. Now, obviously, you got tax implications, and you got to whatever 1031 them or find other strategies. It's like, but it's silly to let. I think equity is dead potential, right? Like if you're just sitting on massive amounts of equity. One of the strategies I really like is portfolio loans. So like I've got 100+ houses where I essentially every year reappraise that portfolio and I'll leverage it to 65%. Well, you might only be pulling out 10 grand on a house, but it's like on a 150, house portfolio, I might be pulling out, 700 or 800 grand or $1 million by literally just doing that process every single year. It's essentially creating its own cash that then I get to go invest. And so that's a strategy I like to use as well.
Yeah, that does make a lot of sense. Um, all right, let's switch gears again because, like I said, you're in a few different industries and we're trying to cover some ground.
Yeah.
Let's go back to the live event and conference space. So, in addition to the AAPL stuff, you're into Think Realty and Aspire and some others. Are there some other like brands and tours?
There's always something. I had FitCon, which is a big fitness convention we sold just last year. So yeah, I love building communities.
That's an interesting combination of industries to be in, especially with all the real estate stuff going on. Um, what attracted you to expand in that space in addition to building communities from like a business model standpoint, from like building connections, growing your network? What are a few of the top things that jump out at you as the attractive parts of those spaces?
Sure. So you're asking me for the secret sauce now, so I'll give it to you. But the what I believe is you build community. And in building community, then, I'm a private equity guy. As much real estate as I've done, I've sold over 120 companies too. So it's like I love buying and selling companies. Now, the way that I do it is I build communities, and then I will essentially acquire or create service or products that essentially serve that community. So, the American Association of Private Lenders, I've done that. I've done it a little bit there, but not as much as like Aspire. Aspire is a big, massive tour. We're the world's largest business tour. We travel every month.
It's huge.
People. But what that is it's small businesses. It's businesses that are 500,000 to, 2 or 3 million a year. And I just look at that. And we put 90,000 of those in an arena last year, so it's like, and I've got their data, I've got their trust. They know who I am. Well, in the last 6 months, I've been acquiring tax firms because when I looked at the data of those 90,000 businesses, I said, what services do they already have on their P&L that they need, that if they knew me and liked and trusted me, they would essentially give me that process. So then I started rolling up tax firms because I realized the big gap between the $3 million business and the $50 million business is the $50 million business gets Ernst & Young. They get quarterly tax planning. They get all this service. And the guy that's at 3 million gets H&R Block, so it's like you're your CPA and you try to figure it out in November, so it's like there's this huge gap. And so what I decided was I'm going to go start buying it, aggregating it, building it, because now I can look at the P&L that they're already spending money on. And then they'll look at me and say, oh yeah, I like your service or product better. And they'll take it. And then they become a very sticky buyer for me, right? So now I create massive enterprise value. I have a built-in customer. And so from a private equity standpoint, building the community, serving the community is the greatest lead gen and opportunity for building businesses. Think realty is similar, right? So how do like I'm building businesses at scale, I'm doing real estate at scale. But how do you keep your funnel full? Well, if I literally build a community that all they do is real estate and they want education on real estate, we serve them. And it's been the greatest deal flow for me, so it's like, you just like go down that path, it's like, so I love communities because I think there's power in communities. But in those communities are the greatest business opportunities that I've, been able to take advantage of over the last 10 years.
It's really sharp when you break it down like that. Create the community, grow it online, offline, and then see how you can serve it with the right products and services. And then you're going outside of that to acquire stuff that's already built and functioning and inserting it into the event, the community. It's pretty sharp, man. One last question.
Yes, sir.
With all that going on, these different business ventures, different niches, how do you juggle, organize, prioritize your week?
Yeah. So for me, I have what's called the Empire operating system. I built an operating system that essentially manages all of my businesses. It manages how we communicate, how we measure. And now it's actually a product. There's about 3,000 companies globally that use Empire. But my week is systematically broken down by putting focus on the things that I'm uniquely good at and governing, right? So if you look at the Empire operating system, it's basically a way to look at all of my businesses fundamentally. And I say this oftentimes, like now I'm back up to 27 companies now, and I'm really just a data analyst at the top. My job is my people. I have to make sure I'm cultivating great leaders. I have to know my numbers, right? And I have to make sure I'm building my big relationships. Like that's my fundamental job. And that's how I break down my day. And then one big piece, though, that we've switched to is that, I had all the exits in 2019, and all of that kind of left me with some emptiness. And I really pushed towards philanthropic work. And so I created what's called Impact Others. And so one of the things that gives me great joy, and I could have just walked away and lived the rest of my life after 2019 with all the exits, but the fulfillment I got in building orphanages and feeding centers and clean water and building businesses overseas, now in over 103 countries, is like, that's the fulfillment that drives me. So with all of the data analyst at the top and building my people and building the relationships, another big portion of what I break off is making sure that our organizations all filter and funnel towards some level of purpose or give back. And so those are kind of my 4 functions as the CEO, leader of all of the umbrella companies.
Very cool stuff. Very cool stuff. You explain it really well. Again, I appreciate you taking the time and being on the show. I think this is going to be a hit with the audience. Yeah. No, I'm going to rewatch this. This is good. I appreciate it, Eddie.
Thank you.
All right, everyone. We appreciate you taking the time to check out the Private Lenders Podcast, and we will see you here next time.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you'd enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for new and experienced private and hard money lenders.